Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a tutorial on current assets. Now, when we hear current assets, it's quite visible that assets over here will be reflected in the balance sheet. So, as we can see, assets over here, the things have been mentioned, the total current assets, which includes all those assets which will turn out or which will materialize or which has to materialize within the 1 year of time span. So cash and cash equivalents, marketable security, or you can say any asset which can be converted into cash or in the liquid form within a 1 year of time span. All of the details have been mentioned, which gives us total current assets. So what exactly are the current assets? Current assets are basically expected to be consumed or sold or converted, you can say, into cash either in 1 year of time span in the operating cycle, whichever is longer. An operating cycle is basically an average, that is average time it takes to convert an investment into inventory back into the cash. So current assets, they are presented in order of the liquidity. This should be really taken into consideration. Now, which are the list of the current assets? Let's understand. The first is the cash and the cash equivalent. Now, companies needs cash to run their day-to-day operations. Cash usually includes like checking accounts, coins, and paper money, undeposited receipts, and money orders. So the excess cash is normally invested in the low risk and highly liquid instrument so that it can generate additional income. This is called as cash and cash equivalents. Cash equivalents may include commercial papers, CP, money market mutual fund, bank certificates. You have certificate CD, which is known as certificate of deposits, and treasury securities. Now, I'll show you the Microsoft 2007's balance sheet and what is the percentage of the cash and short-term investment as the percentage of the total assets. Let's see that. As you can see, the cash and cash equivalents of Microsoft of 2007, the total cash and short-term investments, as you can see, 23,411 in 2007 and 34,161. So what is the percentage of the cash and the short-term investments to the total assets, which is actually really high, right? So as we note from the above, you can see the McDonald's percentage of the cash and cash investments, short-term investments to the total assets was close enough to 52.28% in 2007 and 69.7%. Sorry, it was not Microsoft, it's McDonald's. So this is how the things have been calculated. The second thing that we need to understand is the accounts receivable, or which is known as debtors. The credit given to the customer is known as accounts receivable. This means that the company has rendered services or delivered the product to the customers. However, it has not collected the cash fully yet. If you compare the Colgate's, we will note something like this, that the net receivable was 1,552 million, that was in allowance. The 54 million was in terms of allowance. This implies that the gross accounts receivable is 1,552 plus 54 million, which is 1,606 million. For this was the case of 2014, and in 2013 the net receivables were 1,703. You can see how significant difference is there between both the years. Let's understand the next portion of the current assets, which is inventory. Now, inventory means the goods and the material that is in the stock. There are three types of inventories. One is called the raw materials, work in progress, which is known as WIP, and we have the final, what we get is finished goods. Now, from this extract, we know that Colgate's raw material inventory was 266 million, work in progress was 42, and the finished goods was 863 million, which amounts to 1171. The next that we are going to understand is prepaid expenses. Now, when we discuss about prepaid expenses, they are exactly what they sounds like. Like if a company, if a company pays, let's say 10 million and insurance premium on the last day of the month, that will provide coverage for the entire month. The company will record how much? 10 million prepaid expense to account for the insurance expense it will show in the month that it already paid for. The next that we are going to discuss is the other current assets. Other current assets basically consist of other non-cash assets. You can say non-cash assets. Companies often combine small accounts into an other category. Detailed information on other current assets may be included in the notes to the financial statement. Analysts should always check the notes in the annual statement of the annual report when the figures are relatively high and if they are unclear what an account represents. Let's understand now the current assets examples. CA example. Let's take a current asset example of Apple Inc. We all have heard about Apple. Consider Apple's last quarter of 2017. The total current assets are separately provided and listed for each of the last 4 years, wherein we can see that the short-term investments, which are quite liquid, are the most of the chunk, and the inventory, on the other hand, which is less liquid, are the least. So receivables here basically represents the cash that the company has already earned and yet to receive. Apple Inc.'s other current assets for the quarter ended in the March 2018. March 2018 was 12043 million. Apple Inc.'s quarterly other current assets declined from September 2017, which was 12864 million, to December 2017 as 11337 million. But then it increased from December 17, which was 11337 to 12043 in March 18. So how to analyze the current assets? The first working capital. The first and the foremost thing is working capital. I'll go to the next sheet. Now, working capital is basically what is your current assets less your current liabilities. Now, this is basically the analysis portion of the current assets, and you can do it by current assets minus current liability to find the working capital. Working capital of, if you see for for the Colgate, the working capital requirement for Colgate had increased significantly to 1033 million in 2016 as compared to 850 million in 2015. The next is the analysis portion is the current ratio. Now the current ratio provides details of how the current assets are placed as compared to the current liability. The current ratio formula is as simple as that: the current assets divided by the current liabilities. Now there's this company called Sears Holding. Its stock fell close enough to 9.8% due to the continuous losses and poor quarterly results. And the current ratio of Sears has been dropping continuously for past 10 years. It is now below 1x, which is not good and does not actually look really very good. The next form of analysis that you can do is the quick ratio. If the inventory and the other current assets like prepaid expenses are large, then it may skew the current ratio. Since such items are not liquid, it is wise to calculate another ratio that is called the quick ratio, that considers only the cash and the cash equivalents and the account receivables. Considering only these two terms, it provides a better view of the coverage of the short-term obligation. So it includes cash and your cash equivalents, and you need to add any accounts receivable, divide by the current liability. So let's finally make a conclusion on all of this. Current assets can be defined as the firm's ability to convert the value, you can say convert the value of all the assets into cash within a year. So if a company has cash, short-term investments, cash and cash equivalents, they would be able to generate better returns just by using the assets. Current assets can range from business like retail, pharmaceuticals, or oil, depending upon its nature. So even if the value of the firm, the financial health of the firm, is determined by the company's current asset, and that's why using such assets makes it a great way to evaluate the firm's ability to provide funding to its operation.